Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Hello, Jim.
Danielle, what's the global economic outlook for this year?
Well, it's been rapidly in flux. 6 months ago and 3 months ago, the prospects or the forecasts for growth in 2022 were quite high, and especially in the first half. And now the consensus has been dropping like a stone. Like even, a couple of months ago, the expectation was for a sort of a 7% growth rate heading into Q1 2022, and now the consensus is down to more like 4%, and it's ratcheting down week by week because I've been talking about this for some time, but we have to try and understand that we had this unprecedented fiscal spending in the economy in 2020 into 2021, and that was globally. That was in all major economies of the world where the governments were, channeling cash into the pockets of businesses and households to try and backstop from the pandemic shutdown. But we just don't have anything close to that being replicated coming into 2022. So there's what they call a fiscal cliff, where there's just this natural drop-off in spending. And ideally, everyone was hoping that that the government would be able to pull back because people would be back to work and the economy would be fully opened, and consumers would have a lot of savings in their banks, and they would be able to sort of continue or go back to spending as if nothing ever happened. But of course that is not going to happen because we're also in this ongoing pandemic, where we have job losses continuing again, where people have used a lot of the cash that they did receive, not for savings per se, but for just living, for paying their overhead, and then there's a certain amount of the population that was funneling it into paying more and more for real estate or speculation in financial markets, and so the household saving rate is back down again to where it was in 2019. So the liftoff or the handoff from the government to the private sector is just not taking place in the way that many people had hoped and dreamed. At the same time, you've got central banks pulling back their monetary infusions. So we know that the Bank of Canada, for example, has already stopped its QE injections into financial markets through its bond buying programs. And next week, the expectation is presently the consensus view is that the Bank of Canada will take the next step and actually hike its overnight lending rate. Now what's, been priced in by the bond market is that the Bank of Canada will do something like 6 rate hikes over the next year. So that in itself is an extraordinary tightening relative to what we have seen since the pandemic started and rates were cut and, all the QE began again. So I think that the monetary fall off here is unprecedented as well. Nothing like anything I've seen in my career, and also, coupled with the fiscal. So we've already seen, it's interesting because the central banks only control the front end of the interest rates. Jim, they control their discount rate, their overnight rate, and presently that's about 0.25. So we're coming into this fiscal and monetary drop-off already at the, this minuscule level of interest rates, which has caused all this speculation and asset bubbles to really billow over the past couple of years. And now, as we look at the net change, just the expectation of the rate hikes coming has already caused the bond market, the treasury market, to sell off. in the past couple of months. And so, that's ultimately what sets longer-term mortgage rates, because although, as I say, that central banks only can tinker at the overnight rate, and that can impact variable rate mortgages, which, if we had something like half of all mortgages taking out in Canada in the last year were variable rate, as you know, Jim. So if we're looking at a point and a 1.25%, 6.25 rate hikes expected between now and the end of the year, that's going to dramatically impact those people that are with floating rate mortgages. At the same time, as I say, because the bond market has been discounting the expectation of these hikes, they've already moved, and so things like the 30-year mortgage bond in the United States, which sets the very popular 30-year mortgage rate in the U.S., has already, is above 3.7%, which is a big increase from the 2.65 where it was in this time last year. So that's a huge increase, and that's already happened just in expecting these hikes to come. And the same sort of thing has happened in Canada because the 5-year bond rate is what sets our very popular 5-year term mortgage rates in Canada. And again, that's popped back up to 1.69 today, the 5-year bond, from a low of 1.18 in December. So that's a very dramatic increase suddenly, and that's going to flow through to mortgage rates. And so this is like a break on the economy because it's one thing to say, oh, well, that's only back to where mortgage rates were pre-pandemic in 2019. The problem is that housing, as you know, is 30% more expensive. So because we've had this really crazy frenzy in the housing space in the past 2 years, and we've seen these really outsized, irrational jumps in pricing that people have been paying, not with cash, primarily with borrowed money. And so, you can have rates go back to where they were in 2019, but housing is 30% more. So, unless people have had a commensurate increase in their income, Jim, or their wages, they just have no capacity to continue to service the debt and continue to spend, never mind save for a rainy day or for retirement or anything of that nature. So we really have this really toxic soup at the moment of very high prices on consumables and, property, as I say, which is a huge outlay for households, the largest, their shelter, as well as things like automobiles where people have, paid 25% more for similar cars they were buying back in 2019. Again, primarily with finance money, all of it very low rates, and now we're getting this huge backup. So what I think is more likely to happen here is that we're very similar to what we saw in the 2008 cycle where you had a big leap in oil prices late in that cycle, and that fed through into inflation expectations, which were also at a very high level. And then you get this extrapolation of people presuming that the central banks will have to hike rates because inflation is high and there's a lot of political pressure to try and quash it. And so what happens is inflation's a lagging indicator, and they start to hike rates, and then asset markets fall out of bed, consumption plunges, and all of a sudden they're back to trying to recant or step back and, look for ways to add liquidity again. But by then, usually you have already lost a lot on the asset market front and indeed on the job front as well. So it's kind of a vicious cycle we've set ourselves up for with this perpetual period of very low rates, tons of borrowing, asset speculation, asset bubbles. Now we're very vulnerable.
What will these expected interest rate hikes do to the housing market, and how big of an impact would that be on the economy?
Well, so that's what I was just touching on. I mean, the Canadian economy has been dependent on housing spending, that sector, for the bulk of its GDP growth now for the last decade. So it's really been the driver. And that's because we really have fallen behind in terms of productive investment in things that give us an edge in the future, that will increase incomes in the future, that will increase our productivity. We just haven't seen, businesses investing in any of those longer term themes, primarily because there's a lot of clouds and questions on where the growth areas are going to be. We're in this major secular transition between the old sort of legacy sectors and businesses and the new, stuff that's needed for the 21st century. And so there's a gap there between what businesses are available and what innovations and technologies need to become. And that takes a lot of capital, and it's a long-term, it's not a short-term fix. It's a long-term investment cycle. And of course, people have become very impatient with anything that takes more than a couple of weeks. And so a lot of funds have funneled into, as I say, quick bucks and asset bubbles. So when you get a backup in rates, and we're already starting to see that where, the home builder stocks in the U.S. have already fallen about 14% because the buying numbers, the Canadian housing starts were down 22% month over month between November and December, but the same thing in the U.S. where you're getting a big fall off in the amount of investing that you're seeing. U.S. existing home sales were about negative 5% in the latest reading. So we're already seeing the impact of higher rates in terms of quelching the ability of people to buy houses. And we're still seeing the frenzy, everyone, multiple bids for properties that, 3 years ago were $1 million and now selling for $2 million. Like it's crazy in many areas, and certainly where I live. So I think what's going to happen here is what always happens, and that is that the revelation will hit that people have paid far too many times their household income, that they really can't afford to service the debt they've taken on and the commitments they've taken on in terms of their housing. Some of them will have to look to sell as the pricing pressure really pinches them. God forbid we get more job losses, which again, we did get actually a tick up in jobless claims in the latest data, which surprised many of the perma bulls. Small business sentiment actually in Canada was at a near record low all time in December. And that's the lowest number in terms of business sentiment in this country since the start of the pandemic in early 2020. So really, I think what we've had is this, as I said, this story of two worlds where we've had a lot of speculation in asset bubbles, and the people that have been, holding or participating have forgotten that it's a cycle, assume that it's their intelligence, that things, that they've seen these huge gains, that they're, got some kind of acumen in terms of picking things, when actually it's just about cash flowing in, speculative fever. Meanwhile, the bulk of the economy and the bulk of the jobs, 98% of Canadian, or 94% of Canadian businesses are not in these publicly traded companies. They're these mom and pop small businesses, revenues under $5 million a year. That's where the bulk, 73% or so of our jobs actually come from that small business sector. They haven't seen, because they don't have shares and, they don't borrow money from investors in the bond market, in the corporate debt market. They have to go to the bank for a loan. They have to go through a much more stringent, financial assessment before they're given cash. And so they've been really pulling back because they have been through, not only just successive shutdowns, but they're looking at this shift in the economy, concerned about where the growth will be, where, it will make sense to invest money. So that part of the economy is in the doldrums again. As I say, is back to where we were at the start of the pandemic. And at the same time, we're seeing a big rollover in a lot of even the publicly traded companies. So the Russell 2000, for example, is the small cap index in the United States, and there's equivalent in Canada, and they're both off about 14% now and back to where they were a year ago. So under the surface of all this hype about the Apples and Amazons and Microsofts of the world, is this very distinct rolling over of speculative appetite. And, that is a warning sign. It's something like we saw in, for example, the top of the 2000 cycle where the NASDAQ doubled in 1999 and everyone thought tech stocks could do no wrong, and the brave new future where, tech companies were going to change the world. Well, they did change the world, but that didn't mean that their shares didn't fall 78%. And here's the kicker that I think is so important. People have not seen a housing cycle in this country for, almost 20 years now. I remember the last two in the 80s and the 90s where everyone was, not even to the degree today, but, in a huge speculative wave of buying properties and thinking real estate could only go up, to see the prices then tank 25 to 40% and take more than a decade to recover. That's very typical. That's how housing moves in a cycle. And that's the kind of thing we should be expecting in the next few years. We should expect to see that prices will roll over and indeed may not make any headway for the next decade. So people should think about that potential scenario before they decide to pile into, more and more property at higher and higher prices. And the other thing is the same goes with the stock market cycle. Again, you may have world-changing technology, but that doesn't mean the shares trading at 10 and 20 times sales make any sense financially, and they don't. And so what ends up happening is people have paid too much, have stayed too long, have really reached for risk because they have decided that central banks have their back, and that, because the sell-off was so rapid in March of 20 but then bounced back so quick, people think, oh, well, I don't care if shares go down a bit, they always come back. Well, in a 50 and 60-year cycle, potentially, equities may always come back, but in a 10 or 15 or 20-year cycle, it may take that entire period just to get back to where we are today. And that's what we've seen after similar bubbles like this. And I always reiterate this because people forget, but the NASDAQ index, after it fell 80% in 2000 to 2002, did not recover that 2000 peak until 2015. That's 15 years. So the only way to really master or have any better prospects, since everything's so inflated at the moment, the only way to actually, get yourself better prospects for the next decade is to not be heavily loaded and levered on these names now, but to keep your dry powder, put some cash aside, and wait for the correction to happen. Because once that happens, you should be able to pick things up at a very steep discount. And I'm talking about property as well as equities and corporate debt and that sort of thing, because everything has been in this crazy trade together. And once that happens, then yields, so the income you receive on things like corporate debt will be 7, 8, 9, 10% because prices will have come off 25 to 40%. The income you receive from properties, if you're buying something as a rental property, will be that much higher because, you're not paying an all-time high in prices, but you may get it 25 or 30% cheaper than present, and so the rent yield will be much higher. And the same goes with equities. If history is a guide here, we're going to see a 50% plus style correction where the instruments that are paying income with a yield today of 1, 2, or 3% will now be yielding 3, 6, 8%. And indeed, if you're collecting that income, if the prices only go up, slowly to recover over the following decade or so, you'll still be in good shape because you're getting this good income flow and you haven't lost your shirt to start the cycle. So that's really the best way people can prepare for the climate that comes next.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, you mentioned during the interview how important it is to have cash to pick up assets at a bargain. How important are savings to survive what could be tough economic times?
Well, this is it. Savings are everything, whether they're for the longevity and ability of a company to ride through an economic downturn, or whether they're with respect to an individual and the prospects of losing their job in an economic downturn, never mind a health problem or a marriage problem, or there's so many things that can happen to people that really come out of the blue and set them back financially. And the extent to which they have a buffer of cash there for them to fall back on or to draw on. As I say, people lose track of what the point of savings are, and it really is to cover us in times of need or want or opportunity. And, you can't have that opportunity if you're constantly tossing money at anything and everything, so that any savings you do have is in these very risky assets. then what happens is that when you go to need your savings, so I always say you want to have some negative correlation between your income, that whether it's your employment or business income, and the savings that you have set aside. Because what typically happens is people take their savings while they're working or while their business is doing well, and they plop it into things like equities at any price without any thought to, return prospects or stability or liquidity and any of that, because in a bull market everyone becomes very risk complacent and they think they can't afford to own any cash because it's not high enough yielding. But ultimately, that's where the store of value lies. And as Charlie Munger has said recently in a CNBC interview, it takes a lot of character to actually control your ego and your, animal spirits and keep your cash safe and powder dry in a world where everyone's mocking you and as if you're not aggressive enough or brave enough, to take on risk. But ultimately, if you don't, take that bait and you are able to preserve your liquidity and cash, then if you go through a downturn, you will have something safe to draw on, which is not falling while you're trying to draw on it, right? Which is what ultimately happens. People put the cash into things that in an economic downturn, the incomes fall and then the assets fall. And so they end up having to sell things at a discount or sell things as they're falling, basically cannibalizing their savings to try and support themselves through the downturn. So that's just a recipe for a nightmare. And that's what people have been doing, and they've been being advised to do that by a financial sales community or a banks community, which is, primarily there to sell them products, debt, risk, so that they can have the cash, right? They build up the cash coffers so that they have the optionality in the future and the resilience in their business model, and they've given all the hot potatoes to everybody else. So you really have to resist that impulse to think that you can't afford safety. We have to have safety. We have to maintain it. Otherwise, we're going to be very vulnerable.
And if interest rates start to rise, eventually you should start making money on savings again, I would hope.
Well, unfortunately, I think that, as I was touching on at the outset, I think the expectation for inflation to continue the way it has been, I think are well overdone. And I highly doubt that we're going to see the type of rate hikes that have been priced into the current bond market, which means that bonds currently would be a buy at these levels. I'm talking about treasuries, not corporate debt. I'm talking about government-issued debt, because not only do you get a higher yield right now than you did a few months ago, but more importantly, if everyone starts panicking and needing to raise cash and continuing to sell things like equities and commodities, real estate, then ultimately that cash starts flowing back into things like government bonds. Again, the safety-seeking inflows, and that means you're going to get a capital gain from here on top of the interest income that you're receiving. So that's a really important thing to keep in mind. And so for another really good example is the People's Bank of China. The Chinese central bank cut rates again for the second time this morning, their overnight rate. Now, they only cut it 0.1 because they're at really record lows there as well, but they're ahead of us in this real estate cycle, right? So their economy has had more than 30% of it depended upon property development in the last few years, which is an incredible concentration and, not healthy at all for an economy to have that much in housing and shelter in terms of dependence. But that's what happened. And so people there, again, have been speculating on real estate, borrowing, buying things at ridiculous prices relative to their incomes. Families couldn't actually afford to live in the properties they were buying, but they assumed that the prices would only go up, so it was worth whatever price was paid. And then you saw that, leverage got so high that the government cracked down on the developers, said they couldn't add any more leverage, and then you saw Evergrande default, which was the most indebted property developer in the world. They're not just in China; they have tentacles in other countries. But now we're seeing that spread through other developers that have been defaulting on their bond payments, on their corporate debt payments, and not being able to complete projects they'd taken on and all that. So I've been watching that as a canary in the coal mine for Canada and other countries that have also seen such a huge housing balloon, because we knew it was a house of cards built on too much leverage. And so what happens is the central bank was cracking down on that, and then now as they're watching everything implode, they've gone back to trying to cut rates again. But as we've seen in other cycles, by the time central banks start cutting rates, that's when you typically see the real cascade and fall in things like financial markets, and it can have months of duration afterwards before it actually finds any bottom, because monetary policy works with a lag of several months, actually a couple of quarters at least. So by the time the central bank starts cutting because they're terrified about the slowdown, usually, that's just a signal for it to pick up even more steam at that point to the downside. So anyway, I just warn people, inflation's a lagging indicator. Central banks are talking strong right now because they're concerned about consumer price inflation getting ahead of itself. But the reality is that the rate hikes that have happened to date are already curbing demand and spending. And then, we're going to get a sell-off in asset markets will reflect that we're going back into a deflationary period. And rate cuts are likely in the second half of the year rather than more hikes.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. If you have any questions for Danielle, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.